Now, I told you yesterday that momentum had shifted for the S&P 500. We already had it with the NASDAQ last week. And again, please excuse my voice. I have a cold. So I appreciate you bearing with me. But we had that sell-off yesterday, and that gave us a drop back below the 10-period moving average. And we dropped back below the lower boundary of the cloud, and we flipped it. You see the little red arrow? You see the little red cloud? You see the little red bar? Momentum has shifted. You see the oscillator turning red? Momentum's bearish. Right now, we're trying to get an inverted yield curve, an inverted hammer off of the 20-period moving average, and the 50 there, we're trying to bounce. Even though we had a down day on the S&P 500, the VIX is predicting that we're going to have an update tomorrow. 95% chance we do, 5% chance we don't. But as I said, when the VIX starts going parabolic, you throw all that out the window. But there's still 5% chance of a failure rate. MACD rolled over today on the S&P 500. Histogram went into negative territory. We've broken the 80 level here with yesterday's sell-off on the stochastic. And again, we had this little divergence, and that's now given us this sell-off back to test the 20 and the 50-period moving average. So, again, momentum has shifted. Signals are bearish. My guess is they're going to turn back to bullish, and we're going to go fill the gap and make a new high, the gap over here, and get a new all-time high associated with the Fed pivot. Again, just before it, with it, or shortly thereafter. If that's not going to be the case, and the signals need to remain bearish and give us a much bigger sell-off, just a pullback. So we'll be watching. But we did have confirmation to yesterday's sell-off. Now here with the MACD rolling over, and stochastic yesterday breaking the 80 level, or I should say dropping below 80 after the divergence on the stochastic played out. Again, let me be clear. I still think we're going to get new highs on the S&P 500, but momentum has shifted. Friday, we had a failed breakout on the intraday charts with the triangle. We attempted to break out. It failed, and now we've seen this shift in momentum there on Tuesday with our short trading week here this week. We're going to get that jobs report come Friday, so we'll be watching to see what happens there. If it's really weak, concerns about recession. If it's really strong, then again, we get more fake numbers out of the Labor Department. They get this really, really strong report, then concerns, the Fed may not cut. We're already hearing that. The Fed may not cut in September. The Fed's going to cut in September. Central banks have already done it. They're going to do it. Again, signals are bearish here for the S&P. S&P's got to get back above the 10, got to flip the cloud. Bullish. My guess is when this pullback's done, we'll do that. So we'll be watching, but my signals currently are showing that momentum is bearish for the S&P. As I've talked about, they turned bearish last week for the NASDAQ. One thing that's really interesting is that we're starting the week off yesterday with the green bar. It's still here today, even though we're selling off. S&P already had this divergence that gave us this sell-off right here of nearly 10%. Again, it's likely going to form another reference point of a divergence here going into the Fed pivot. So again, eventually I think we will make a new high on the S&P and diverge with NASDAQ that will go up and fill the gap at 20,400. And when that happens, you're likely going to witness a top on the S&P 500. S&P weekly here. NASDAQ doesn't have a green bar yet. It's losing the 10-week moving average. So again, I talked about this larger corrective move for NASDAQ and then going back up and filling the gap and then turning down. Still think that didn't go high enough, back up to the 20,400 area and then sell off. We'll be watching to see if we get a green bar this week or next week with the NASDAQ. NASDAQ weekly chart here. NASDAQ daily chart. Again, we saw the bearish reversal of conditions last week. It remains that way. We dropped below the 10 period. We remain below the 10 period, the red line. Okay? Saw momentum shift to bearish. So now we're seeing the MACD roll over. And if we've had a 5-lead push lower here, I think you're getting an A, Maybe it ends a little higher, maybe it ends a little deeper back towards the 200, and then we go back up to 20,400, and then I think you're going to tank and top surrounding the Fed pivot, surrounding the inverted yield curve. As I'm talking about in this video, things I talked about yesterday, things I talked about last week. Again, what will give us a bigger rally is if we get back above the 10 period, the red line there, and if we get to flip the cloud, NASDAQ's taking out the 10, it's taking out the 20, and the 50 period moving average. So we're below those levels. Yesterday's bar, we were up over 20% with this bar right here back above the 20 period. We hopped back above the 50, back above the 10. Black candlestick, possible hanging man candlestick. No guarantee, but the VIX is predicting an update for either a bottom or a bounce tomorrow. VIX starts going parabolic, you throw that out the window. There's a 95% chance we're going to have an update tomorrow. Now, as we got this black candlestick and possible hanging man, the S&P got an inverted hammer. The 20 period moving average, we're at the upper band right here. So again, we'll be watching to see if the VIX tries to pull back or not with the black candlestick. Doesn't mean the sell-off is over. It means the VIX is predicting an update tomorrow for a bounce or a possible bottom. If we bounce, we could still sell off as we move into the jobs report on Friday. But again, the VIX can fail if it starts going parabolic, which it looks like it might be. The VIX predictions become less reliable. The S&P 500, even though the MACD rolled over, RSI broke 50. It's now down at the 49.5 area. Got an inverted hammer today at the lower end of the cloud of the 20 period moving average. So we'll be watching to see if we attempt to get some kind of recovery back up towards the 10. Again, the MACD rolled over today, trying to bounce, even though we were down in the S&P. We rallied up and then we sold off, and again we got this inverted hammer. Well, the VIX got a black candlestick, we got a hollow red candlestick, so we'll see if we attempt some kind of rebound or a bottom. Again, the VIX is predicting a bottom or a bounce. Tomorrow we'll see if it's correct. No guarantee it will be. Indicators perfect. More often than not, the VIX is right. What happens? Stochastics breaking 80, again just above the 50 level. Do we get some kind of rebound and then sell off further, or do we try to bottom out? We'll be watching, but as what I can tell you is momentum turned bearish yesterday for the NASDAQ, or I'm sorry, for the S&P. It turned bearish last week for the NASDAQ. My momentum signals continue to remain bearish. In order to go higher, those signals have to turn back to bullish. Now here we've dropped below the 10 period. We're trying to bounce off the 20, the cloud into the future, momentum cloud turning red. Again, RSI breaking 50 at this point with MACD rolling over. So we'll see if we attempt some kind of rebound. If we do rally, you can stall around the 10 period moving average. When we broke the 10 over here, the red line, we move back up to it. Could see something similar to that if the inverted hammer plays out. Bring it up close, you can see this inverted hammer. Here it is. It's an inverted hammer. It's a possible reversal bar or a bar that could give us a bounce. Hollow red candlestick as well. So possible reversal bar or a bar that can give us a counter trend rally. NASDAQ got a similar bar. It's below the 20 period. It's below the cloud already, below the 10 and 20. The RSI has already been in the negative region, already breaking the 50 level on the stochastic. And again, our MACD is rolling over. So again, does this give us a bounce or a bottom? Is the VIX going to be correct? We'll be watching. But let me be clear. Momentum is negative. It has to turn back to bullish in order for NASDAQ to try to go fill the gap at 20,398. Daily chart here. NASDAQ's lost VWAP support. Risk of coming down to one of these longer term VWAP support levels. We've lost the support from the low here, from the low here. So again, the risk is NASDAQ comes down to here, or comes down to here, or comes down to here. Late August, I warned you that another 9 count was setting up on the NASDAQ. And sometimes you see them play out immediately. Sometimes you go a little higher. This one marked the top. This one, we went higher for one more day. Couldn't close there. You got your bearish engulfing. Talked about that candlestick at the time. And again, we've seen this sell-off. NASDAQ stalled at just under the 78.6 Fibonacci of this decline of 15.75%. You got a possible inverted hammer again. I've talked about at great length and detail. Momentum signals remain bearish. As long as we hold above the 10 and it's curling over here, you could see, again, if this is a 5-leg push lower, you could see an A, a B, something bigger, or coming back to test the low, or something more shallow. You could get a B, and then it could be followed by a C to come back up here to 20,400, going into the Fed pivot or shortly thereafter. And then you can see, so I think that NASDAQ has peaked. I told you as it was happening, leading up into it, rallying into your resistance on light volume lines in the weekly time frame, and I told you to be watching for a reversal with the CPI. That did happen. Dropped 500 points to the 10. I told you we were going to rebound to the 78.6 fib. That happened. Then bottom fell out of the NASDAQ rather quickly. Warned was going to happen off those trend lines of resistance. Again, NASDAQ, I believe, is in a topping process. Eventually, we're coming back up here to 20,398, the 20,400 area. Whether it's this and we get it now, or whether it's, a deeper retracement and then we get a rebound, maybe at the 200, larger Fibonacci retracement of this advance right here, whatever the case may be. I think we're coming back up to here. When that happens, the S&P will probably be making new highs, and then I think you're going to see the market top. Let me be clear. Again, I believe the market is in a topping process. My signals will eventually revert back to bullish. Momentum is bearish right now. I believe they will revert back to bullish to complete the topping process. So do keep that in mind. You got an inverted yield curve here, inverted hammer here on NASDAQ as well. So we'll be watching to see does that do something to try to turn things around or give us a bounce. X is predicting an update tomorrow. That jobs report where we might have more volatility surrounding that come Friday. Looking at momentum in the 4-hour time frame again, we were kind of flatline forming the diversions. We ended up forming divergences in the 60-minute time frame, in the 4-hour time frame, without giving us a bigger sell-off. We were just kind of sideways here for a while. So again, when this turns back to bullish, when momentum turns back, the momentum line's bearish, the cloud is bearish, our size in the negative region, when we start seeing these signals turn back to bullish, NASDAQ's probably going to go back and fill the gap at 20,400. S&P's probably going to go make a new high and top out. And all this will likely happen in the coming weeks ahead with the Fed pivot, meaning that they're going to start cutting rates. But a beautiful turn back up here, a rebound for a lower high, and then another turn here. Beautiful reversals back and forth, bullish and bearish. So again, good shot that when we see signals turn back to bullish, if that in fact happens, my guess is it will, we'll put the finishing touches on a topping process. S&P 4-hour chart here, and it remains negative. Same thing here for the NASDAQ. NASDAQ momentum has remained negative. RSI's in the negative region here in the 4-hour time frame. So again, could get something bigger and then the rebound, or it could see something more shallow. We'll be watching regardless of how it plays out. NASDAQ is likely going to come back and fill this gap at 20,398. Does, it's probably going to set up a lower high, and S&P will probably make a higher high, and the market will probably peak. It'll be followed by a reversal, start of a crash move, and usher in a bear market. These charts you can see right here again, S&P 4-hour time frame signals turning bearish, momentum validating it. That's got to change in order to make new highs. If this remains, we go lower. Right now momentum has shifted back to bearish. My guess is it'll probably turn back to bullish at some point. but my signals are bearish for the moment. S&P 4-hour chart here. Here's the NASDAQ again. Everything bearish here and momentum negative. So again, bulls can turn that around and we'll go fill that gap. If not, we're going to go lower before we attempt a recovery. A bigger sell-off, again, a larger ABC move or a more shallow retracement. See how it unfolds. I told you yesterday the momentum line shifted to bearish on the S&P 500 daily chart. We've got to see that turn back to bullish in order to turn things around. NASDAQ daily chart, we saw the gray area show up telling us, hey, something was getting ready to happen. It is. We're getting a bigger sell-off. Again, momentum went negative. Red bars. Red momentum line. Trend is flatlined for the swing move. Short-term trend, we're taking out this line right here, representing the short-term trend, which is bearish at the moment. The risk is we get a bigger sell-off, maybe towards the 200, towards a Fibonacci retracement, towards the gap fill, if we have more volatility at the jobs report. But again, eventually, NASDAQ is likely going to come back and fill the gap at 20,398. The S&P got that 9 count. I talked about these 9 counts previously as they were forming. Got a bearish engulfing, but we just kind of went sideways, and the S&P formed a divergence that eventually gave us this sell-off or pullback here. Possible inverted hammer at the 200 or at the 20. But again, it still may end up that we get a bigger sell-off. We'll see what happens. But the 9 count giving us a sell-off. Go make a new high, it will give us a trend extension after that 9 count. P daily here. And I think there's a pretty good chance that the Dow has peaked. This divergence right here, more evidence of that, but again, just speculation on my part. And I told you, most people don't have the guts to tell you what they think. Talked about this with that 125-year trend line last week. Talked about the divergences that were forming on the Dow. You know, I told you on July 11th, I should say, that I thought July 10th was the top. Or the NASDAQ, I still think that. I still think S&P is going to move to a new high. How could be topping? Most people don't have the guts to tell you what they think. It's happening. They wait until after it's already happened. I'm telling you, hey, I think that you got a possible top here. Could I be wrong? Dow can flirt with this area and the longer-term trend line a little bit more. I think you got a shot that this divergence is a top with the Dow. You're watching the S&P. How big of a sell-off do we get? Versions have formed, and again, RSI does not look at the shadows and the wicks. It only looks at the close. We had this little divergence taking us back down to the 20-period moving average, dropping below the 10. Now, we still have the S&P reversing off of this trend line with our log scaling. Signals begin to turn back to bullish at some point. I'll be watching to see if we can make a new all-time high, possibly pushing above that trend line. For now, it's acting as resistance. S&P 60-minute chart, again, failed breakout last Friday. We had the market closed on Monday. We have a short trading week. We began to sell off on Tuesday. We're selling on Wednesday. 60-minute charts are bearish. Daily momentum is bearish. Here we're below the momentum line, the purple line there, the momentum cloud. They're pointing down. We're just above the 200. I'll be watching to see. We attempt to bounce where we've become oversold. Momentum here, but we got to see a reversal on the intraday charts to get some traction back up. Otherwise, again, we could test the 200 and move beyond the 200-period moving average. Again, Elliott wave is speculation, but I've talked about those possibility of a wave 4 pullback and then to go make a new high and have it be wave 5. If we have 1, 2, 3, somewhere in here, 4, and then 5, again, Elliott wave is totally speculation. So again, counts could be invalidated, so I never trade Elliott wave. To try to determine trend direction, validating or invalidating counts. Again, talk to you about these divergences. Initially, we kind of went sideways. Now we're seeing a bigger sell-off. We came back and filled the gap at 55.73. Another gap down here in our 200 period moving average I'll be watching. Still think the S&P will likely move to a new high, but in order for that to happen, I need to see my signals turn back to bullish. Again, we have the gap over here, at the very top. So I think it's likely we're going to make a new high and fill that gap in all likelihood, which the peak was at 56.69 and rounding up 56.70. Now, sorry for my voice. I have a little bit of a cold, so sorry if I sound funny. Today we had the uninverting of the yield curve on an intraday basis. It didn't close that way. To have a reading of 0.04 negative reading, 0.04, just below the center line. I told you to be watching to see if we get the inverting of the yield curve. Predicting recession has a historical record of being correct. Start seeing the steepening of the yield curve. Now, again, maybe it goes positive and goes back to negative and then eventually goes back to positive again, or maybe it goes positive and stays there. The uninverting of the yield curve, bearish for the market, and it's predicting recession, is right around the corner. We had it on an intraday basis today. See if we get it on a closing basis this week, next week, whenever. We had this brief intraday uninverting of the yield curve. The financial media is trying to tell us how wonderful this is. The bond market yield curve returns to normal from the inverted state that had raised recession fears. It's going back to normal. Have the soft landing that people on the financial channels have been telling us. And again, it's not going to end well. It's going to end with the recession. We're going to have another financial crisis. Oh, this is so positive for the markets. No, the uninversion of the yield curve is extremely bearish. Warning, recession is right around the corner. See it happen on a closing basis at some point very soon. This week, maybe in the weeks ahead. If we pull back, we'll see what happens, but it's going to happen. Sooner or later, it's going to happen. Relationship between the 10 and the 2-year Treasury yield briefly normalized Wednesday, reversing a classic recession indicator. No, it uninverts, signals the recession is about to happen. It happened following economic news that showed a sharp decline in job openings. Dovish remarks from Fed President Bostic, which is always dovish. This isn't the only article. I mean, I've shown you the charts over and over. Again, when you get the Fed pivot, which we're about to have, an inversion of the yield curve, which we're getting on an intraday basis, again, recession shows up. The bursting of the tech bubble, the NASDAQ formed a massive topping process with a lower high. Again, everybody believed it was over. Nobody believed the NASDAQ was about to drop 82%. We had the setting up of the lower high, the yield curve began to steepen. As it began to steepen, again, we began to see a sell-off, and as it began uninvert and steepen, it got even worse. Things unfold in different ways, different times, but the moral of the story is steepening of the yield curve leads to this. We have the steepening of the yield curve right now. We're trying to get the uninversion of the yield curve between the 2 and the 10. And what do I mean by inverted yield curve? It means that the term rate, the 2 years higher than the 10. Now that's flipping back to where the 10 is higher than the 2. This is suggesting the Fed is about to pivot and we're about to move into recession. Here's the S&P 500, 2,000 top. I showed you the NASDAQ. S&P peaked, came down. 5 months later, rallied back up to get a lower high, seeing the steepening of the yield curve. And again, this happened. As I've talked about, by the time we got the Fed pivot, market had already dropped sharply, got a bounce for 3 weeks, one of these counter trends, and then it resumed the decline. Steepening of the yield curve correctly predicted the recession, and the market tanked, and we got the Fed pivot. Things were all associated with the recession. The inverted yield curve was associated with a topping process. We just have a much larger topping process because the Fed has blown the bubble so big. We have the inverted yield curve, we have the un-inversion of the yield curve today on an intraday basis. We'll see if we get it on a closing basis in the coming days or weeks ahead, maybe sooner, maybe this week, maybe do it with the jobs report later in the week, or a little bit more time regardless. Again, it's suggesting we should be looking for a topping process. Now, the time we had the un-inversion of the yield curve, the market had already peaked. As I pointed out in 2007, let me just bring up the chart. In 2000, we had already dropped 19.5%. We got a little bit of a bounce by the January 2001 rate cut. We saw the bottom fall out of the stock market after that, dropping 51% from the high. 2007, we got rallied back up with the first rate cut, and we rallied for about 3.5 weeks. And both times it was 3.5 weeks. No requirement that that's the same kind of timeline that we'll get a bounce or a rally, but this one did work out the same way. We rallied for we got the Fed rate cut September 18th. We rallied for 3.5 weeks, formed a top, then we dropped 20.5%, rallied, and ended up dropping 58%, rounding up. The Fed's cutting rates because we're moving into recession, and then recession hits. Trying to ease the pain. We see the inverted yield curve correctly predict it. And the warning signs are there, but I mean, this kind of stuff, the yield curve returns, normal, inverted state had raised recession fears. The steepening of the yield curve after the un-inversion is when the recession begins to hit. Again, a very bearish thing for the market. Financial media and the experts on the financial channels are going to tell us how wonderful this is, and the Fed's going to dodge this recession and all this other nonsense. It's Kool-Aid. The retail investors, all this nonsense about a soft landing is propaganda. It's not, then why are the institutions selling into the rallies? Again, we had the un-inversion yield curve today briefly on an intraday basis. That's warning, and here it is again. That's warning that the time is short. Now again, I've said that the NASDAQ has likely peaked. I still think that. The Dow is trying to peak from last week's high. I think the S&P is going to move to a new high. Likely diverge with NASDAQ as it eventually will fill the gap at 20,400. NASDAQ goes back and fills the gap at 20,400. The S&P will likely peak around that time. Well, we're about to get a Fed pivot. Now seeing the attempted un-inversion of the yield curve on an intraday basis. Market's just going to go ahead and sell off. Well, the momentum signals turned bearish yesterday on the S&P. They remain that way. Maybe that's the case. My guess is it's not going to be the case. It's the S&P volatility oscillator. Still below the signal line. It's got to get back above the signal line. Trend direction ended up forming multiple points of negative diversions. Finally, getting back above the signal line. This is the volatility oscillator. This is the S&P. S&P dropped 27.5%. We got above the signal line and we stayed above it. Okay, we pulled back to it a couple of times. We're consistently above it while we had a sell-off. The advance, we got above it a couple of times with the major declines here. If we're going to see the market peak, got to get back. The S&P's got to get back above the signal line here. Volatility rising, breaking down out of this trend line right here, forming a bullish falling wedge. So that's why I still think the S&P is probably going to make a new high. But again, as of yesterday, momentum signals turned bearish on the S&P 500. If they revert back to bullish soon, bigger sell-off and they revert back to bullish, chances are we're still going to see a new all-time high surrounding the Fed pivot just before it, with it, or shortly thereafter. And that's why I showed you the charts. Again, we peaked the Fed pivot in 2000, 2007. We peaked just right after the Fed pivot. This is the S&P trend direction. Okay, we got above the signal line. Volatility sharply increased. As it increased, the S&P sold off, and we went into the negative region for the S&P trend. We had volatility get above the signal line. Volatility sharply rose. S&P dropped, and the S&P trend direction went into the negative region. It wasn't until it went back into positive territory that the market bottomed out. So while we have a divergence here with the trend direction, I still think the odds greatly favor the S&P is going to go make a new high. The gap occurred right at the peak, the S&P's July high. NASDAQ got the gap after a lower high had set up. Again, I don't believe NASDAQ will make a new high. In all likelihood, S&P and NASDAQ often diverge at top. So I think we're pulling back. I still think we're probably going to see the S&P make a new high. I think we'll still see NASDAQ reach that 20,400 area. But again, momentum is bearish at this time. Now, for the session, the Dow was up 38 points, just under 0.1% higher. S&P was down 0.16%, down almost 9 points to close at 5520. NASDAQ was down 0.3%. Russell was down nearly 0.2%. The VIX was up nearly 3% to close at 21.32. Again, I told you that we're going to start seeing evidence of the labor market slowing. We've already seen the SOM rule trigger with the 3-month moving average of the unemployment rate, that we're going to have a recession. Talked about this recently quite a bit. Even if they fudge the numbers, it's eventually going to show up. They'll be doing is putting lipstick on a pig. I mean, from March of 2023 to 2024, they revised the numbers by 818,000. I mean, fake numbers out of the Labor Department, likely because it's an election year. They quietly revised them down later. Now we're seeing job openings falling to more than expected in July, showing further weakening in the labor market. Job openings sank to the lowest levels in 3.5 years in July. Warning signs. We're about to get the jobs report. Warning signs that recession is coming. Eventually, you're going to see the negative jobs show up. A warning sign that we're about to move in recession. Eventually, that's going to happen. One of the jobs that are being created are government jobs. Again, artificially being propped up by the government because we're in an election year. A lot of people go, well, we've had these warning signs of recession. Why hasn't the recession hit? The Fed has had a tightening financial conditions, but the government continues to spend like drunken sailors. We're spending more money any other time in history, $7 trillion a year. We've had all the stimulus, but now things are reverting back to where they were before the stimulus. $6 trillion of stimulus checks, the Fed, QE infinity and beyond, all this stuff is inflationary. Government hasn't stopped the crazy spending yet. Now it's the end game. The recession is upon us. It's going to happen. We're going to have a recession. We're going to have another financial crisis with the banks. Commercial real estate nightmare is going to spill over into the banks, have more exposure to commercial real estate than they did to the subprime mortgages during the financial crisis. We're going to have another one. Part of the reason why the recession hasn't hit yet, the government spending is offsetting what the Fed is doing. But all this stimulus and this government spending, there's going to be a huge price to be paid for all of this. Have a recession, it's going to be ugly. Another financial crisis, it's going to be ugly. So there you have it. Warning signs of cracks in the labor market.